In January 2021, GameStop went from under $20 to an all-time high of $483 in weeks. Some hedge funds, big money firms chasing aggressive returns, were sure the company was worth less, so they went short, betting a stock will go down rather than up. And maybe they were right, later at least. But here's the thing. When too many people crowd the same exit, being right on value means nothing. Not if you can't survive the price explosion first. Why do smart people get trapped by a bad train faster than beginners expect? You leave a concert at 11:07 p.m. The lights snap on. One side door is open. At first, nobody moves. People check texts, finish a drink. The hallway feels wide enough. Then rain starts pounding outside, and somebody yells that rideshare prices just doubled. The whole room pivots. The door did not get smaller. The crowd got urgent. That is what a crowded short. Too many traders share the same bet and exit feels like. Price can look calm for days. Then it jumps, and everyone sharing that bet suddenly wants out. When too many traders share the same idea, they also share the same exit. And exits behave differently under stress. The first few people slip through. The next few bump shoulders. Then panic does the rest. In trading, rising price hurts a short more with every step up. Losses grow. The broker may demand more cash to keep the trade open. If you cannot add it, the trade can get closed for you. Notice what failed there, not the original story, the escape plan. A company can still be weak. Earnings can still disappoint later. None of that helps if the squeeze, a fast price spike that forces shorts out, arrives first, and your account cannot survive the ride. You already understand this in daily life. You don't wait until smoke fills a room to wonder where the exit is. You check first. And if the only door is tiny, you get uncomfortable fast. Same idea here. Before you take any trade where lots of people may rush for one door, ask one simple question. If price moves hard against me today, who else will need out at the same time? If that clicks, subscribe. I post 2 of these weekly. Because once you ask that, the next question gets sharper. How can 2 traders hold the same view, but only one survives the squeeze? Your phone buzzes at 10:18 a.m. The stock you're betting against is up 22% before lunch. You still think the company is overpriced. That part may be true. Traders call that your thesis, your specific reason for taking the trade. But a correct thesis won't protect you from a bad clock. Now put 3 lines on paper before you enter. First, if price rises to this level, I'm out. That's your line in the sand, no debate later. Second, if too many big players are already making the same bet, I go smaller or pass. Those big players are hedge funds, and when they're all betting the stock will fall, that's a short. Third, if the move starts forcing people to exit, I leave early. Why? Because losses on a short can keep growing as price rises. The pain itself creates more buying. People rush to close their positions, the trades you currently hold. That rush pushes price even higher. That's the trap. You can be right about value and still get steamrolled by timing. GameStop was the perfect example. A lot of big funds saw a weak business. But once the crowding got extreme, the trade stopped being about value. It became about the exit door. So the real question isn't, am I right eventually? It's what happens first, my thesis playing out, or the crowd stampeding for the exit. And that's why 2 traders can see the same stock, hold the same opinion, and end up with completely different fates. I still think GameStop is overpriced. 2 traders say that on the same morning. One of them has a tiny short, a bet that a stock will drop instead of rise. He set his loss limit before the market opened. If the price hits it, he's out. No debate, no ego. The other works at a hedge fund, a big money firm chasing aggressive returns. Same thesis, his specific reason for the trade. Same view on the business. But the fund's position, a trade it currently holds, is so large that getting out isn't like stepping through a door. It's like emptying a stadium through one hallway. That's the whole difference. It isn't who sounds smarter. It's who can leave. If your trade is small, you can be wrong, take the hit, and move on by 10:42 a.m. If your trade is huge, every tick up hurts. Other traders see the pain. They know you may have to rush for the exit. Now the price isn't just rising. The crowd is leaning on the same door you're trying to reach. And here's the twist. The smaller trader can keep the same negative opinion later. He exits, waits, and reassesses. The big fund may still be right about the company's value months later, but that doesn't help if the position forces him out today. You see this outside markets too. 2 people know a restaurant is overpriced. One shrugs and eats somewhere else. The other signed a giant catering contract. Now he has to pay whatever the kitchen demands. Same opinion, different commitment. Same idea here. A trade only works if your account can survive the path, not just the destination. That's why being right eventually is such a dangerous sentence. Eventually can arrive after you're already gone. This is also why a crowded short is different from a normal disagreement. You're not only arguing with the market, you're sharing a tiny exit with everyone who made the same bet. The moment fear spikes, individual decisions turn into a stampede. So when GameStop started shooting higher, the real damage wasn't just the price move itself. It was what that move did to the people trapped behind the same door. And once that door jammed, things got weird. At 9:37 a.m. on January 28, 2021, your screen looks broken. GameStop is ripping higher again. The number keeps changing before your eyes. A week earlier, this still looked manageable. On January 22nd, GameStop closed at $65.01. Expensive? Maybe. Overhyped? Maybe. Plenty of hedge funds thought so. They weren't betting on the company to improve. They were short, betting a stock will go down instead of up. In plain English, they wanted the price to fall. On the value argument, some of them may have been right. GameStop was a struggling mall video game store. That part wasn't crazy. The trap was size, timing, and too many people crowding into the same idea. By late January, short interest in GameStop had climbed above 100% of the shares available to trade. That's the key fact. More people were betting against it than there were shares to escape with. Now put yourself in one of those seats. It's Tuesday morning. Coffee's getting cold. Chat is popping. The stock closes January 26th at $147.98. Then January 27th at $347.51. You keep telling yourself the same story. This price makes no sense. It has to come back. But price does not care whether your story makes sense today. If you're short and the stock rises, your losses can keep growing as it climbs. And when lots of traders share that same losing trade, they all need the same escape route. To get out, they have to cover the short, buying to close the bet. That forced exit can push the price even higher. That's the squeeze. Then came January 28th. GameStop hit an intraday high of $483. Not over a year, not over a month. That same day. At one point the move was nearly vertical, and the pain won theoretical. On January 25, Melvin Capital needed a $2.75 billion cash infusion from Citadel and .72 after huge losses on its short position. That's what a crowded exit looks like in real life. Not a bad chart, not a bad headline, a survival problem. What's interesting, this is where the three-question test matters. First, where are you out if price keeps moving against you? Second, how big is the position, a trade you currently hold? Third, is this a real setup, or are you just hoping value shows up before the squeeze gets worse? Most trap traders had a thesis, your specific reason for taking the trade. Fewer had an exit they'd actually obey. And that's the whole lesson of GameStop. You can be right later and still get carried out now. In February, the stock eventually came down hard from those extremes, but that later collapse didn't help anyone forced out near the top. Once the crowd starts shoving through one tiny door, being correct about value becomes almost useless. So, the real question isn't whether your market view is smart. It's this: how do you decide the exact price where you'd rather be wrong early than dead right too late? One number decides whether a smart idea survives a dumb crowd. The price rips higher, your chest tightens, you still think the company is overpriced. But every green bar means your loss grows, and your brain starts bargaining. Just a little higher, then you'll get out. That's exactly when you need a rule. I call it the when to fold test. Quick aside, if this helps, subscribe. There's more twice a week. Before you take the trade, answer 3 things in 10 seconds. First, where is your fold? The price where you quit to protect your money. Not somewhere above here, an exact price. Second, what is your position size? How much money you put into one single trade? Small enough that getting hit at that price hurts, but not enough to wreck your week. Third, what is your thesis? And be honest, is this a real setup, or are you just hoping? Can't answer all 3 fast? You pass. No debate. No, I'll figure it out live. Live is where fear starts talking. This matters even more on a short. A price can only drop to 0, but it can climb way more than you expect. So your upside is capped. Your pain is not. The pattern is clear. That's the lesson GameStop burned into people. The crowd can stay irrational longer than your account can stay calm. So what exactly should that fold point look like on your next trade? Grab a sticky note before your next trade. Write one line. If price hits this number, I'm out. Not unless, not maybe, just out. Can't write that sentence in 10 seconds? Then skip the trade. Protect your account, the money you have to trade with. Want more plain English rules like that? Subscribe. Next time, I'll show you why small losses feel unbearable and how to stop that spiral early.